Hey guys, today we're going to be talking about petty cash funds and how they are created and used within a business. Put simply, a petty cash fund is an amount of cash kept aside to pay for minor expenditures within a business. This can include small items like stationery or milk for the office. The amount of cash in the fund can vary depending on the size of a business. A small business might only have $100 set aside for petty cash, while a larger business could have well over $1,000 in the fund. However, no matter what the value of the fund is, the processes of petty cash remain exactly the same. Petty cash can be broken into three components. Firstly, we establish the petty cash fund, then we go about using the fund for small payments, and lastly, we replenish the cash in the fund. Let's explain this with a real-world example. Petty cash funds should only ever be maintained by one individual as means of internal control, because all responsibility of the fund is put onto one person. Let's call this custodian James. If the business in which James is employed wanted to start a $100 petty cash fund in the beginning of a new time period, James would cash a check for $100, then create a journal entry where he would debit petty cash and credit cash, which simply shifts around the assets. Now, if another employee of the company named John needed to buy some stationery for the office, he could do one of two things. He could either buy the stationery with his own money and request reimbursement. James would then exchange the receipt for petty cash, keeping the receipt as proof of purchase. Or John could ask the custodian, James, for funds for the stationery. In exchange, give him the receipt after the purchase has occurred. Now it's time to replenish the fund. So a petty cash fund replenishment report is created to gauge how much money is required to refill the fund to its initial balance. For example, if we originally had $100 in the account and at the end of the period there was only $80 left, then that would mean $20 would be required to replenish the fund. This figure would be cross-checked with the $20 receipt John received for the stationery. We can now record all expenses in a general journal entry, which would debit the expense account and credit the cash account. Sometimes errors can occur within the account balance because of either a lack of receipts or incorrect cash being given out. The solution is a temporary expense account called cash over in short, which will have either a credit or debit balance and is used to correct the error. If John only gave a receipt for $15 but took $20 petty cash, $5 would be added to the cash over in short account as a debit and the account would balance.